The federal budget has created plenty of discussion around housing, negative gearing and capital gains tax, but one of the more interesting flow-on effects may be what it does to commercial property. So we all know that they are penalising existing residential investment through the removal of negative gearing, plus the removal of the 50% CGT discount for basically all assets. For the past 25 years, a lot of Australian investment behaviour has been built around capital growth. So investors bought residential property, often accepted a lower rental yield and relied on negative gearing to soften the cash flow pain while they waited for the values to rise. So if that system changes, the incentive may shift from chasing future capital growth to chasing current income. A well-leased commercial property is usually purchased for its income first. So a supermarket, a medical centre, childcare centre, fast food investment, lease shop, etc. They're all generally valued by looking at the rent, the lease term, the rent reviews, tenant quality, and the yield that investors are prepared to accept. Capital growth still matters, of course, but commercial property is more often an income asset than a speculative capital growth asset. And that capital growth is generally manufactured through smart decisions and hard work. This is similar to what some commentators are now saying about the share market. If capital gains become less tax advantaged, then startups and high growth companies that reinvest profits and rely on future share price appreciation may look slightly less attractive, while mature companies paying consistent dividends may look more attractive. In simple terms, investors may start to value the cash flow they receive each year more than the capital gain they receive in 10 years. Commercial property has some similarities to that high dividend share market argument. So this doesn't mean that commercial property suddenly becomes a perfect investment. It's more complicated than residential property. There's vacancy risk, leasing risk, land tax, GST, make good obligations, incentives, fit out issues, and plenty more things to master. On the other hand, residential property generally has fewer moving parts and therefore fewer things that can go wrong, making it easier for investors to understand and manage. But for investors who are prepared to do that work, the relative appeal may improve. There are also many funds and syndicates that invest in commercial property and specialise in managing the asset and the risk while still providing a great return to those investors. We'll probably see this across two areas in WA. At one end is the smaller private investor market that go it themselves. They typically sit in the $1 to $7 million leased investments such as medical, allied health, childcare, fast food, neighbourhood, retail, etc. At the other end is the larger market where investors more often access commercial property through those funds and syndicates that I mentioned rather than buying the assets directly. Overall, commercial property already appeals to investors who want income. If residential property becomes less tax effective for future investors, some of that private capital may start looking more seriously at commercial property.